Okay, good morning. Today is August 24th. This is a live trading training session number 5, finishing it up. If you're interested, we're going to start all over again. We're going to, month of September 16th to 21st, we're going to be covering everything, session 1 through 5, all over again. So actually, just about a month from now on September 21st, around this exact time of, we're talking about 1 o'clock London time, 8 o'clock Eastern time, we'll be doing this again. And of course, today's recording will be available. So let's start right here. And okay. So this is a picture of me and my buddy Assad from Guernsey. Took this at the airport, and my buddy here sent me this really nice. I don't know how he did that, but that looks great, doesn't it? It's something I look at every once in a while, cheer me up. All right, let's put that away. Let's move on and get up the old PowerPoint and slideshow from the beginning. Oh, I did a couple of things I didn't do. I didn't share a couple of. Let me stop for a sec. Sorry, I need to start over. I want to share the give you the ability when you ask a question that everybody in the room can see it. So choose all participants when you send me a little message so we all know where we're at. All right, go back to monitor number 2. We'll do that one more time. There we go. And okay. All right, very good. So chat, I need my chat function. There we go. Now I got everything I need. Okay. We're good to go. All right, so we always start off with the disclaimer. Basically, there's a good chance you're going to lose when you trade. There's definitely no guarantee you're not going to lose. Doesn't matter what happened in the past. So you shouldn't trade to rent money. I do like that picture, Assad. That's a classic. Like I said, I look at it every once in a while to cheer me up. Okay. Not suitable for everyone. You should have a clear investment objective. And actually, when I was doing live trading, I showed this example. Maybe I'll show it to you again if I can find it. I think it's a great one. Basically, run your ideas by somebody, and you should think about whether you know enough to actually be trading real money yet. But I ran this by my last group, and I'm just trying to think where it is. If I can find it quickly, I'll just show you quickly. If not, I won't, but I think I can. Just give me 1 second. As always, I don't work from a script. I kind of just rough it as I go along. So not as nicey as we'd like it. Here it is. And basically, okay, so a lot of you have these ideas about how much money you're looking to make. And I just want to run this by you so you understand a little better what you're really dealing with. This is money management. So a simple statement like, all right, let's say you're going to take this program and you're going to open an account for $5,000. I think it's possible to make $1,250 a week. This is something, if you read an email, you may be getting these kind of emails. And you want to think about what somebody's actually saying when they say something like that. It would imply that with a 5,000 account, you could make 5,000 in 1 month. Because if you can make 1,250 a week, and there's 4 weeks in a month, they're basically saying you could start with 5,000 and in 1 month make 5,000, which means at the end of the month you'd have 10,000. And assuming you could scale it, then each month you would be doubling your account. And what that means is in 1 year, you would have $20.4 million. And in 18 months, you'd have $1.3 billion. And within 2 years, you would be the richest person in the world. because the richest person in the world, according to what I heard from somebody in live trading yesterday, was $77 billion. So you become the richest person in the world if this was actually true in 2 years. Now, if you take it a little further, just for the hell of it, and you were to continue on, in 30 months, you'd have $5.5 trillion. In 2 years, $343 trillion. In 4 years, 1.4 quintillion. And in 5 years, you'd have 5.7 sextillion. And these numbers, believe it or not, are bigger than all the money currently in the world. So the idea of being able to double your account every month, is pretty out there when you consider even in 2 years you'd be the richest person in the world. So it's good to try and, I'm relating this directly to, have a clear investment objective. Definitely run it by your friends, because I know a lot of you have these crazy ideas in your head. You're going to open an account with 2,000 and you're only trying to make 500 a week, which is the exact same thing as saying you're going to be the richest person in the world in 2 years. So run it by somebody and see if they think it's reasonable. I think many of you are unsuccessful for one simple reason. You're trying to make too much. You're trying to be able to do something that is not humanly possible to do. That's the problem. And in many cases, you're looking to take shortcuts and don't even know what you're doing. So it's kind of a double-edged sword there. All right, so let's put this back slideshow. Armed with this knowledge, and let's see what's going wrong here. Why is this backwards? Okay, that looks a little better. Let's see what the next one is. Yep. Okay, so let's get on to news trading. What makes exchange rates go up and down? Well, it has to do with news mostly, and sometimes the prices become attractive on the charts, so it becomes a little bit of a self-fulfilling thing. So if it looks like it's been going sideways and starts to go up, people think it'll go up further. And if it's gone up quite a bit, people think it's too high, it'll come back down, and sometimes that works. So to some extent, exchange rates move up and down based on charts to a very small extent. Most of it has to do with the underlying news about the currencies and how the market is interpreting the news at any one time. And the key thing to remember, guys, is it's not what the news is, it's how the market is perceiving the news at that particular time. So it's always a constantly changing thing of what's important. So when I got into business, there was something called the money supply. So let's see if I can doodle. Let's see, what I would need to doodle is get my hands on this one, that one, maybe that one. Yeah, I don't know if I can. There we go. Yeah, all right. So when I started in this business, the big one was called the money supply. And this used to move euro dollar, well, not in those days, there was no euro dollar. Let's say pound dollar, because that was the currency I traded. The money supply numbers would come out, and the pound dollar pair would move 200 points in 2 minutes. It would just go 200 points higher or 200 points lower every Thursday at 4 o'clock in the afternoon, because at the time when the government reported the money supply, the market would move like crazy. That lost its vigor, and the next really big one, because the U.S. was worried about its trade balances. So the U.S. trade balance swung very much into the red, and it became a big issue when the U.S. government started to stress that they had to correct the trade balance. So every month when the trade balance came out, pound-dollar pair would move up or down 100 or 200 points in a matter of a minute or so, and related to the trade balance. And that eventually went by the wayside. And some of them have remained pretty consistent over the years. We'll talk about what they are. But it depends on whatever the market is talking about at the current time. And this shouldn't be a problem for you. This shouldn't be, well, Jimmy, it shouldn't be that way. Everything else in life is that way. Things change. Things are constantly changing. The way people view things change. Their opinions as things mature, they become less important. When they're new, they're more important. This is just like everything else in life. And when you trade, if you can get used to the idea that that's the way it is, it makes it a hell of a lot easier to trade from the point of view you don't have that attitude that you should be able to kill it, that you should be able to make tons and tons and tons of money from foreign exchange as if it was different than everything else in the world, because it's not. It's just as difficult as any other kind of trading, and that's one of the things some of us need to get used to. Because I get emails from people, and I get the impression they're disappointed because they can't make money on every trade every day, and they can't totally understand what's supposed to happen. Because we have to realize that information is never complete, and we've talked about over and over and over again that 40% of the time you're going to lose, and we can't forget the fact. No matter how hard we try, we're still going to get it wrong plenty of the time because markets are imperfect. But we can strive to get it right, but it just doesn't work out that way. Now, when it comes to charts, traders, they look at the charts. Actually, I use the word peruse. Means people mentally masturbate. They spend hours and hours and hours and hours studying charts, and then they come up with an opinion. I think the pound's going to go up, or I think the pound's going to go down. Then they make their bets based on those opinions. And most people just look at charts. News, the fundamental, most people ignore this one. What the news does, it tracks the important economic news about the currencies, or it's the countries that the news is about, the countries themselves, and each country has a currency. And generally, when the news is a lot better than what they expected to see, they'll buy the currency. And when the news is a lot worse, they sell the currency. That's pretty much the pattern but the news has to be very important stuff, has to be important enough to get traders to change their mind. So, and again, what's important changes, just like in your own life, what's important changes as your life goes on. Now, most traders prefer the charts. In fact, most traders just look at the charts because that's what they're taught. A few of them prefer the news, very few. I think you need both. And that's what I try to teach. I try to teach you how to use them both together as much as possible. So we're going to learn about the news in this webinar. We're going to talk about the news trading in particular. What are the benefits of learning the news? Number one, you won't be in a trade right before a major news announcement and watch your trade go right through your stop loss plus another 50 points in a heartbeat, because you'll be aware that market moving news is coming out, and regardless of what your charts are saying, it's going to move a tremendous amount if that news is a surprise. And it has nothing to do with your trade idea, especially if your trade idea is a shorter term trade. If your trade is for the next 50 or 70 points, the next 50 or 70 points will be a result of that news event in many cases. So by being aware that news is coming out, you can avoid unexpected losses, and then specifically from a stop loss point of view, where you put in a stop loss and you think you're protected, and all of a sudden you see a big gap in the market and you get slipped on your stop loss. See, that can be avoided with some decent risk management, some knowledge of what it is you're doing, some knowledge of what the news is. A lot of times you can have a better trade selection when you incorporate into your chart how the price got there, what's causing it, how the news event is impacting it. And over time, you'll get better and better to be able to have a feel for how long that news is likely to impact. It'll give you another dimension to your trading. If by coincidence you like a trade technically and the news confirms that your technical opinion is likely to be correct going forward, that's giving you additional confirmation or courage to perhaps take a nice size position. Because in the end, what it comes down to in this game is having the courage and the conviction at times to take a large position and make a lot of money. I know some people try to scalp it and do all kinds of other things that don't work. And lastly, it gives you some trade ideas a lot of times. It'll give you something to think about. Gee, that news seemed really good based on everything I have here, including Jimmy's statistics. Yet this currency didn't go up. This currency must want to go down. Well, coincidentally, I thought this currency wanted to go down anyway. And this news just confirmed my opinion. Oh, look, it's starting to go down. Well, let me get in there and take a nice, hefty position and make some good money, because I'm really in tune with this market from a technical and a fundamental point of view. It's doing exactly what I think it should be doing. That kind of a trade has quality to it and deserves a quantity-sized trade, and probably a successful trade in most cases, probably much more than the 60-40 relationship we look like. It's all those marginal trades you guys do where you're just kind of winging it, guessing at it, I know there's certain guys that they always got an opinion. They always got an idea. No matter what the market's doing, they got something that they feel is going on, and it doesn't have to even be a strong opinion. It's just, they always got something. This pair's going up, or that's happening, or this is happening, which is good as long as it's quality, as long as there's something behind it. It's just not very surface level selection going on. So let's talk about profiting from the news. Right away, the main guys here. We've got Mario Draghi for the European Central Bank. The European Central Bank's still not out of the woods. Europe is not still out of the woods. They haven't really solved any of the problems over there. They certainly, by speaking. And incidentally, it's interesting that we're talking here about speaking, because if you think about it, if you think about what he's accomplished by speaking, what he's accomplished just by speaking, well, actually to some extent doing, definitely him, he's all talk, and he's accomplished so much in terms of calming the markets down, etc. So speaking is a big part of it these days. It's not actually doing anything. It's just talking about doing things is the latest weapon, if you will, that these central banks, these are central bankers, these are the guys who run the money for the countries. And again, if you're new to this, this is for Europe, this is for Japan, this is Ben Bernanke for the U.S., Mark Carney now for the UK, and Glenn Stevens for Australia, and they guide the markets. This guy Glenn Stevens keeps telling us, hey, the Aussie currency's too high. Well, it's gone from $1.05 down to 90 cents this year. And this guy's saying the Japanese country, the country of Japan, needs to create inflation. Well, creating inflation is bad for a currency. And this currency's gone well against the dollar. It's gone from about 80 up to about 100. So a big jump in that one this year, mostly related to the fact that they're trying to create inflation. And the U.S. dollar, well, we got Bernanke, and, well, he's got this idea that the U.S. has to print tons and tons and tons of money to keep the economy going. And the economy don't seem to be going. However, he says, well, if I didn't do what I did, it would be doing a lot worse. And so, this is what's going on these days. Everybody's just talking, and it seems to work, but at some point, things get all out of whack. And we're probably right as we speak today at a position where traders in general, markets in general, they totally they totally come up with a way of trading the markets related to what these guys are speaking about. But I think it's pretty clear to the guys who are making the big decisions, talking about stock market traders and people investing billions and billions of dollars of our retirement money on a global basis, not just dollars but other currencies. The rules of the game are convenient for whatever's going on at the time. So the thinking is now that the U.S., for example, as long as the U.S., and this has been going on for years now, the last few years, as long as the U.S. is printing tons and tons and tons of money, that's good for stocks because there'll be money, people have money to buy stuff. And if the U.S. starts to stop to print all this money, that's bad for stocks. And so we have a situation where in 2008 things have gone totally down the drain. Things remain totally down the drain, yet our stock markets are hitting all-time new highs. So obviously, we're not really that far from a 1929 situation where prices are probably completely out of line for certain things. But that's the way it is, and we can't worry about this as traders. All we can do is say these are the rules, and based upon what the rules are going forward, we need to do our best to assume that whatever way it's been up until now, but today that's the way it is. And this is where you guys got to learn this because this is critical. It really doesn't matter whether it makes sense or don't make sense. The only thing we care about as traders is what's going on right now. Okay, so tomorrow when there's news out, this is what should happen because this is what's going on right now. Whether it makes sense or not is totally irrelevant. What we need to try to figure out is what is the market likely to do tomorrow, and that's how I teach. We try to figure out one day at a time, and from that point of view, I mean, some people try to, I got an email from a guy, for example, and he's talking about the situation in Europe and saying, well, overall Europe ain't doing that good, so the euro's really not that good, so bigger picture, the euro should go down. That's all fine and dandy, but are you going to put a trade on and hold it until that happens? Or are you looking to put a trade on that you're going to get right correctly today? And if you're going to try to put a trade on to get correctly today, you need to focus on what's going on today, because that's going to determine the result of your trade today. And that's something that takes practice to learn that, to try to get your trading plan together so that you're actually doing something that makes sense. Now, when these guys speak, where do we find the information about where they're going to speak? Well, every month or every 6 weeks, depending on the country, they're going to put out a statement, and it's going to say, this is how we see our economy doing right now, and this is how we see it doing in the future, and this is where our interest rates are, and this is where we see them going in the future, and this is how our inflation looks. This is how we see it looking in the future. And so we're going to get official government statements about for each country every month or 6 weeks about how they see the economy doing, how they see it doing in the future. All that information every month. Some of them after these meetings or at other times have press conferences to talk about how things are going. And then the actual meeting, after they give us a few paragraph summary, they actually give you a 30-page summary with a lot more details. So we do get a lot of information from these guys on what's going on and what they'll be doing in the future. And in this case, they're actually trying to tell us as best they can what's going on. But also because what they say can become self-fulfilling, they also, to a great extent, they have to sugarcoat it. So you always have to take it with a grain of salt that they can't necessarily tell you the truth because that may create a self-fulfilling panic. So they're always they're kind of always hedging to the optimistic side purposely, because expectations create realities in the market. This is something the central banks have learned over time, that if they talk negative, they can create a negative scenario. And they've also learned by talking positive, they can create a positive scenario to an extent, because they can do all the positive talking they want, but then they have to deal with the accountants, because we do get the real numbers. So they can say, don't worry, everybody's going to have a job, but every month they have the numbers coming out for jobs. And they could say companies are going to be doing a lot better, and every month companies report how they're actually doing. And then the whole economy is summed up as one number every 3 months, and the inflation rate comes out every month. So they can say whatever they want, but you still have their actual numbers that they have to be somewhat reasonable with. Hey, that almost looks like Alfred Hitchcock's profile. They have to be somewhat realistic because there is the actual numbers. Now, when it comes to the central bank and the people who know what they're doing in this business, when these economic news releases come out, whether it's the retail sales or the employment or the GDP, inflation numbers, when the numbers are good, and we'll define what good means, there's less need to print money, and that causes the currency to go up. Printing money, when you need to print more money, it causes the currency to go down. So when you get bad news, there's more of a chance they're going to print money, so the currency goes down. When you get good news, there's less of a chance they're going to print money, so the currency goes up. Now, how is it classified? How do you know what good news is, and how do you know what bad news is? Well, for most releases, there's a consensus forecast of some kind. There's a forecast. So if the actual number is a lot better than the forecast, then it's less QE, so the currency goes up. If the actual number is much worse than the consensus forecast, the currency goes down. So it's always relative to what's expected. A pretty basic concept, really. You have an expectation. If you're disappointed, you sell. If you're very, very happy over the top, you buy. So what the next level of this would be, well, how do you define significantly better or significantly worse? And we do that by looking at the actual numbers over time and saying, what has caused traders to change their mind in the past? I can't think of any other way you can possibly do it. I'm pretty much the only person I know that even bothers to do it this way. If you ever try to get some ideas on what's expected, is easy to find, but how to trade it is very, very hard to find. Everybody can explain after the fact how you should have traded it, but nobody wants to take the step of sticking their neck out and saying before the fact, what do you think is going to happen and how it's going to move. The news services, they seem to, they have one or two guys who are always willing to give their opinion, and they have to keep relying on the same ones. The only ones I see that's really good at it is Kathie Lee. Kathie Lee, she she's really good at, she sticks her neck out. She says, this is what I think, and this is why. It could go the other way, and this is why. So she'll give you both sides of the story, and she'll give you her, her idea on which one is more likely. And because a lot of times when I search to get some ideas on these news events beyond my, my own documents that I personally keep to try to keep track, a lot of times the only person I can find who's any help is Kathy Leon. A lot of times when I go to search a news event, say I'll go to Google News and I'll put in U.S. interest rate decision, and I'll see 1,000 hits, and 995 of them will be, yeah, that news is coming out on Tuesday. That's it. Be careful, or this should be a good thing to trade. The news is coming out. Nobody ever bothers to tell you, well, not bothers to, but they probably don't know. Nobody ever tells you how this is going to happen. They just tell you it's coming out. The news is coming out. So pretty much almost all of it is totally useless. But I do find that Kathy Leon, she's useful. She actually has something to say. Now, the question for you newer people, I don't know how many people, I know I can see a couple of new people in the room here, but a lot of you guys I know are not new. Where do you get the consensus forecast? Well, for free, you can get it at Forex Factory. You can get it at Daily FX. You can get it at Baby Pips has their own calendar, and they're going to tell you what's expected, the consensus forecast numbers. And those are pretty readily available out there, the forecast of what's expected. And then there's the actual number after that. Get the actual number, and you can also get that for most. Well, if it's an actual, it's just a number. You can get it from Forex Factory. So if you're talking about an inflation number or an employment number or a retail sales number, it's just one number. You can get that directly from Forex Factory at the time of release. When you're talking about an interest rate decision or minutes of a meeting or a press conference, well, then you need something more than Forex Factory to get that kind of information. Talking Forex over in the UK, that's £20 a month, is very good. That's £5 a week. If you want to be able to get, all of the main news items, you can get it there, and in very timely fashion. Or TradeTheNews.com is the one I use, and that's good too. Talking Forex is cheaper, and I think it's okay. At least it's much better than having nothing, that's for sure. Now here's an example of how it would work. They have a consensus forecast, and we know this before the fact. I would say how long before the fact? Probably 4 or 5 days. Maybe even 7 days. 7 days before the fact, you'll have the expectation of what the number will be. So you know a week in advance at 8:30 in the morning Eastern Time on Friday. So not this Friday, but the following Friday, or that'll be August 6th or something like that. You're going to get the U.S. August 5th. You're going to get the non-farm payroll, and there's a certain expectation. We won't know that expectation until next Saturday. Bloomberg is the one I like to look at. It'll tell us next Saturday what they expect that number to be. So that's where their consensus forecast comes in. Then on the 5th at 8:30 in the morning, they're going to tell us what the actual number is. So the difference between those two numbers, this is where the anticipation of a reaction in the currency markets is likely to occur. And what you're looking for as a trader is how much of a difference is going to cause traders to change their positions. How much different does this number needs to be from 162 to get traders to change their trades? So it's related to the U.S. dollar. So obviously, well, maybe not obviously at all. Let's just say not obviously. If the U.S. creates a lot more jobs, that's a good thing. If it creates a lot less jobs, that's a bad thing. If the U.S. creates a lot more jobs, maybe there's not as much need to print money, so the U.S. dollar should go up. If the U.S. creates a lot less jobs than what the market thinks were created, see, if you think of the consensus forecast as what's already priced into the current exchange rates, then when the news actually comes out, if the number is much different than that, then the price of the currencies or currency, the U.S. dollar, has to adjust to reflect that information. And because these change in pairs, because the U.S. dollar trades against the euro as a pair, and the pound is a pair, and the yen is a pair, et cetera, et cetera, et cetera. Okay, Abdullah cannot hear anything. I assume that's his computer, so okay, got to deal with him. Okay, everybody can hear fine, I assume. Fine, so it's your computer. Yeah, thank you, Jack. Thank you, Roy. All right, so the actual number, is important to the extent that traders are likely to change their mind. And to determine what's going to change their mind, what I do is I simply look in the past, and I do realize every day is different, every week is different, the technical setups are different. But if I see a consistent pattern that a certain size difference between what was expected and what we actually got tends to cause the dollar to move in a directional way, significant directional way, well, then I can assume that today, if it's different by that amount that seems to consistently move it in a predictable way, that it'll probably move like that. Does it have to? No. Is it likely to? Yes. Does it mean we can definitely make money from it? No. But knowing what's likely to happen has to give you some kind of a advantage over having no idea what's going to happen. That's the easiest way I can explain it to you. Glad to hear it. Okay, the guy who couldn't hear can hear now. That's a good thing. All right. U.S. dollar increase. Okay, so in this case, the number was much better. We created a lot more jobs than expected, so the dollar increased substantially, as it should. Why? Because the U.S. government, Mr. Bernanke's been telling us that the most important thing in his mind is jobs. So if he says the most important thing for determining whether they're going to print money or not, whether they're going to increase or decrease the value of the U.S. dollar, is based upon jobs, and more specifically, if we get more jobs, they'll print less money, so the dollar will go up. If we get less jobs, they still need to continue to print a lot of money, maybe even more, they say, so the dollar will go down. Now, this is the thinking in August of 2013. Was it the same 5 years ago? No. Was it the same 5 years before that? No. Will there come a point where nobody will care about the non-farm payroll? Probably not. It's always going to be a factor. It's just a matter of how important it's going to be at any one time. And you know how important it is because you listen to the guy who runs the country's currency, and he tells you what's important at any one time. If you choose to ignore all this, again, you're trading, you're basically trading out your ass. You're just basing it on some kind of charts that are only a small part of the total picture. So your chances of being successful are pretty slim. So now, when we saw that number of 236 versus 162 expected, how could we have profited from that? Well, the short answer is you need to buy the US dollar. And how are you going to go about doing that? Well, you could buy it before the news if you felt the number was going to be good. You could buy it when the news is released if you think the dollar is going to have a big move up on that news. Or if the dollar makes a big move up, you could try selling it. There's several different ways you could potentially profit from that news event. Now here's how I do it very specifically, looking at the numbers. I explained to you the theory of how I do it. Now I'll show it to you with numbers. So this is the UK GDP, and it comes out every month, every quarter, every 3 months. If you notice these dates, it's the exact same day of the month even. And the next one after this was 4/25/13. And the one after that, I don't know if it was 7/25 or not. I can tell you later. We'll take a look. Probably was, or maybe it was the 26th. Do I care? No. What I know is approximately every 3 months it comes out. And what I'm interested in is how big are the differences between what they expect and what they actually get, and the direction of those differences. So when you compare an expectation of positive 0.1 with an actual of minus 0.2, it tells you it's minus 0.3 worse than the expectation. So this number of GDP is the whole economy is one number. So it's bad. It looks bad. Is it bad enough, though, that the price of the dollar will go down? That would be the question you'd want to ask yourself, because the news apparently is bad, and if it's bad news, the currency should go down. If the currency doesn't go down, and it consistently doesn't go down on bad news, and it doesn't go up on bad news, well, then the news is simply not important. It's that simple. If the news is important, then there should be a reaction to it. Traders should quickly change their mind about some of their positions on it. When you think about the fact that how big the Forex market is, some people should find this news, if this news is important, it should cause people to change their minds. So now we're talking about the UK GDP. So because we're talking about the UK GDP, we're talking about the pound, GBP. That's the currency. We can't trade one currency at a time. We trade in pairs. So if we're going to trade this, because the US dollar is the biggest currency, we would tend to put it versus the US dollar. Now this news is going to come out at 4:30 in the morning, Eastern time in the US, 4:30 in the morning, 4:30 a.m. in the morning. That's on the East Coast of the US. It's going to be 1:30 in the morning on the West Coast of the US. So everywhere in the US, it's going to be between 1:30 and 4:30 in the morning when this UK news comes out. So I think it's fair to say that pretty much everybody in the US is asleep, which means that the US dollar, there's no news at those hours most likely in the US dollar. What that means is, in terms of the currency pair, when this news comes out about the UK, the pound-dollar currency pair exchange rate is going to be impacted because the news has to do with the pound. And because the news is about the pound, it's actually going to cause the pound-dollar exchange rate to move. So the dollar is going to move by default. The pound is going to be worth more or less dollars based upon the news. So when the news is bad, the pound is going to be worth less dollars, so the pound-dollar exchange rate is going to go down. Is that what actually happened? Well, with this little summary that you have access to, that I send you every week, updated, nice, beautifully updated every single week, well, did it actually go down? Yes, it went straight down 52. It didn't go up at all. So apparently the market responded to the news. Here the news was bad, and it went straight down. Here the news was good, and it went straight up. It didn't go down at all. Here it was bad, straight down. So just from this little analysis here, you can get a pretty good idea of guessing what's going to happen on April 25th. By looking at the differences and how the currency pair moved, you could make an assumption of how it's going to move on April 25th. So let me clear that slide up a little bit, and let's see if you can do this. So on April 25th, the market forecast is 0.1. And from looking at these differences, it's pretty clear that a difference of 0.2 or 0.3 or 0.4 or 0.5 is likely to cause it to move. At least from looking at this, you could make an assumption of how it would move. So why don't you go ahead and make that assumption? So we want to know, if I want to know what a positive difference that'll make a difference is, based upon this, I would say as long as it's different by 0.2 positively, meaning 0.2 better than the forecast, which means an actual number of 0.3 would be 0.2 different. Of course, if it turned out to be 0.4 or 0.5 or 0.6 or 0.7 or 0.8 or any number higher than that even, then the difference would be more and more positive. So we would definitely expect a minimal movement in the pound-dollar pair. And because it's good news for the pound and there's no news about the dollar going on, we would expect the pound-dollar pair would go up. And bad news, we would define it the same way. What would a difference of 0.2 mean? Well, if the expectation, what we're seeing a week in advance is 0.1, and we want to know what a minus 0.2 difference is, if we go from 0.1 plus to 0.1 minus, that's a difference of minus 0.2. So any number minus 0.1 as the actual number, minus 0.2, all the way up to infinity on the minus side is going to be a bad number, and we should be able to guess what a minimal negative price movement to pound would make. So take a moment right now and looking at these numbers, try and fill in these two. And once you fill these two in, simply adjust the exchange rate and fill in these two. So I'm going to ask you to fill in those numbers. You should be able to do that. If you can't do that, well, then you come back on the 16th and you listen all over again, or you listen to the recording tonight after we fill in the numbers for you. If you can't do that, you really shouldn't be trading. And you shouldn't be trading until you have some clue what you're doing. So I'm going to give you a minute to go ahead and do that, then I'm going to fill it in. So I'm going to wait 1 minute. Okay, let's fill it in. All right, so the number is better than expected. If it's 0.3 or more, it's significantly better than expected. So we expect pound dollar to go up. How much? Well, looking at these numbers, at least 50. So we should be able to go 50 higher. And probably not lower at all because the news is good, so it's going to go straight up. Here the news is bad, so it's going to go straight down. That's what should happen based upon the information we have. And you'll never have complete information about anything in life. So if you're waiting for that, it's going to take you a while. 152.85 plus 50 So we should target, this is the price right before the news comes out. We should target this going up to 155, 153.35 at a very minimum, and we expect it not to go down at all. So it should stay there. The first move should be at least 50 higher and not lower at all. Over here, it's bad news. It's bad news, so it shouldn't go any higher. It should stay. The high should not increase because it should immediately go lower. How much lower? 50 points. Subtract 50, you get 152.35. At a very minimum, you need to be very clear on how this works, and you should be totally capable of doing that before you place your next real trade. You should at least be able to totally understand this. Okay. Now, what are the possible news trades? Well, possibly you could put a trade on before the news is released. You could put a trade on after the news is released. You can put it on trying to catch part of the price spike, or if you think the spike is over, you could try to catch a retracement or a reversal of that price spike. Now, how would you go about figuring out how to get into a trade before the news? Why would you want to put a trade on before the news? Well, it's possible that you have a very strong technical view and you feel that the pound-dollar pair is going up most likely no matter what happens. Even if the news is bad, it'll just be temporary. Perhaps you feel that the news, based upon what you've been looking at and all, you think it's going to be a good number, very little chance for a bad number. So you feel there's a very good chance. Maybe you think both. You think it's going to be a good number and you like the direction of that currency to begin with. So it would make sense to put a trade on before the news. Sometimes you have a situation where the news can be good, but it can't be bad. And that would involve trades where there's words involved, not necessarily a number. For example, sometimes currency or countries that are in a position where they're telling us we're definitely going to raise interest rates. It's just a matter of when. Well, when they tell us that, there is literally almost very, very, very close to a 0% chance they would lower them. I would say there's a 0% chance, but that wouldn't be incorrect because it could happen. Anything can happen. You know, you could walk across the street 3 times and all 3 times get hit by a car. It's just unlikely to happen. Very unlikely. Well, when the governments are saying we're going to raise interest rates soon, we don't know exactly when. There is a chance that on that day they could lower interest rates, but the chance is the same as you getting hit by a car the next 3 times you walk across the street. So pretty much there's no chance. Under those conditions, and depending on what the market's talking about beforehand, sometimes you're in a position where it appears that if they surprise us and raise interest rates sooner, the currency will go up 100 points. If they do nothing, that's what's expected, so it'll stay the same probably. Maybe it'll go down 10 points. So you got a situation where you may be able to make 100 or lose 10. But you have to be careful with that because you don't know for sure. You don't know for sure unless you actually do the work. And again, a lot of everything we talk about, whether it's fundamentals, technicals, whatever it is, a lot of it has to do with being patient and doing work and actually making an attempt to really understand what you're doing. And then, of course, actually doing it and gaining the experience from what you're doing. And from a mature person point of view, you know, gaining experience does not mean messing up a trade and, you know, throwing your breakfast bowl against the wall and bitching and moaning about it. That's not experience. That's just being an idiot. Real experience is, you invest a very small percentage of your pot on any one trade, and if the trade works, you make note of why it worked and how it worked. And if the trade doesn't work, you make note of why it didn't work and how it didn't work in a mature way. Not this one worked, that's my genius. That one didn't work, Jimmy's an idiot. That's not going to count as experience. That's not going to have you grow as a trader. A big part of this business is just growing, and the more you grow, the more you realize you have no clue what's going on, and therefore you're becoming a much better trader because you're realizing just how difficult the game is, and therefore you're respecting it a lot more, and you're respecting the fact that even though you thought you had a genius method, it doesn't always work, and getting very mature about what you're doing. And that's the hardest part of this game. In the month of August, basically, I more or less told you every day pretty much, this ain't worth trading. Well, if you're in there trading it every day, hacking away, trying to make shit up, and you've lost a significant amount of money, well, now, if things are good in September, and I've taken a month off and almost the entire month off and haven't lost any money, and you've lost a substantial amount of your pot, well, you got to make back all you lost, and you're dealing with the mental baggage of saying, shit, I never get this right, and I'm perfectly okay. I still got my pot, and I'm thinking, okay, I'm starting to see a market that's worth getting invested in. This is the difference, and if you multiply this by a career of trading, you can see why some people come out ahead and some people come out behind, because that really, truly, beyond all of this trying to figure it out stuff, is the real reason people are successful and not successful at this. And this fantasy of winning huge, huge amounts, becoming the richest person in the world in 2 years, you're not going to hear seeing bankers talking that way. Bankers are all about, let me make a few dollars today. How can I make a few dollars today? How can I keep it going? How can I keep from getting in trouble? No one in a bank is talking about being right or wrong. They're just talking about making sure you don't lose too much money and hopefully be able to take a little something out of it. And this is the way real trading works, guys. Let's move on here. What do we got? How do you get in on a directional move after the news is released? Well, it's going to be a price spike. So when we look at the news and we want to get in on it, we're assuming that we've decided, based upon our statistics, et cetera, that we're going to see a price move, maybe 50 points or maybe more. And we'd like to get it on it, but we know one of the problems of doing that is slippage. We know that if by the time we see the news, professional traders and robots, mostly robots, have already traded on that news. So the price is already on the move quite a bit. And depending on your broker, depending on the structure, whether you have fixed spreads or variable spreads, all of this is critically important to decide whether or not you can trade it at all. It's a lot different on the bank side. So for example, on the bank side, when I'm dealing on a machine, and I'm looking at a price on the dealing system for the pound-dollar pair, and the price right after a news event, I'm seeing maybe the price is 153.15 to 20. If I hit buy, I'll have my computer preset that I deal on a standard amount, unless I change it. So let's say that amount is 10 million, so 10. So it knows when I hit the buy button, it tries to buy 10 at the price of 20. If it can't buy them at 20, it doesn't buy anything. When you hit the buy button to buy at 20, It's an instruction for your spread bettor or your Forex broker to buy at the next best available price. And on a news event, it could be 15.20 that you're looking at, and he may come back and tell you bought at 80 or you bought at 70, which isn't what you wanted to do. You wanted to buy around the 20 or at 20 optimally because you knew it was going up. But it's already, the price has already moved. And in a couple of seconds it takes you to see the price coming in. That price is already changing. I hope you realize that. I think most of you do. So what I'm saying is, here's your computer screen and here's your spread bettor. So the news comes out, and at the current time you have a price as the news is coming out. Let's say it's 15 to 17. That's the price. You can use the big number here, 153. You're seeing this. Now when that news hits, let's say the news is bad. So now the new price is 152, 69 to 71. That price is coming to you as you're trying to sell here. So the price you're actually going to sell at by the time this comes back here, at very best, is going to be this price, which is 46 points different, lower than where you wanted to sell. And some people think that they're getting screwed, but in reality, it's not that they're getting screwed, it's just the way the system's designed. There has to be a little bit of delay in there. And also, this is the price before the news. And this is the price after the news. This price no longer exists. How can I explain that to you in terms other than trading? My brain ain't working so well today, so I don't think I can whip up a quick example. It's a pity getting old. It sucks. But basically, this is the old price, and that's what you're seeing. And the new price after the news is coming in, and that's on its way to you. If you try and say sell here, you got to realize that you're going to get this price, or maybe even a lower price, or maybe even a little higher price, but it's going to be different, much different than that price. And that's the way it should be. So now what you can do is you can come up with a price you would like to trade at, and you can put a price in the market to deal at the price you like to trade at. That's another way of doing it. And if that price becomes available, you do it. If that price doesn't become available, you don't do it. And that way you know what price you're getting. So if you tried for this price, and you said, I only want to deal at this price if it happens, well, then you just simply wouldn't do a deal because that price doesn't exist. It would be as simple as that. Now, somewhere in the middle between this price and that price, let's say you say, I want to deal at 152.80. Well, that's somewhat reasonable. It's 35 points lower than that price. So maybe that price is doable at some point in the next few minutes, or maybe it's not, but it's much more realistic than trying to deal on this price. So that's another way you could do it. We'll take a look at an example of that. The third way, the way that I think all of us should be able to do, because it's very simple and it doesn't take place until the news is completely digested, is to wait until the news has been absorbed into the price, or you think it has, and then when the price starts to retrace, jump on board. It would be as simple as saying, wait for a 50-point move, add a 60-period simple moving average, and when the price goes back through that moving average, that's your trade signal. So I got this one here is very simple. I can show you example after example after example of it. So this actually is the January 25th UK preliminary GDP. The forecast was 0.1 minus. The actual was minus 0.3. It was significantly worse. So we'd expect it to go down at least 50. It actually went down 50 in the first minute. So now that it's gone down at least 50, we would add the 60-period moving average And when the price goes back through the moving average by just one tick, 1 point, that would be our buy signal. We put our stop below the low that occurred on the news spike below there, or a minimum of 20 points, whichever one is greater. So you'd risk at least 20 points. Why would you not risk less than 20? Well, you could, but it's not what I like to do. I like to give my trades a chance to actually work. I'm not buying lottery tickets here. I'm trying to trade the market. And so that would be the buy point, and there's the stop loss. A 1-to-1 take profit would get you out right there. That's one way of looking at the profit target. If you had a view, it could go even further. You could try to make more on the trade. How much more? Let's not forget who the trader is. The trader is you. So based upon your knowledge of the markets, what other currency pairs are doing, what day of the week it is, what time of the day is, how much it's already moved in that direction that day, you come to a decision of what you think you'd like to do with that trade. You may think, you know what, I'm going to hold on to this trade for a week and make 800 points on it, or I'm going to lose 20 points on it because my long-term view is up. And maybe right over here now you got 20 points profit. A lot of you would be running and grabbing your 20 points instead of the 800. You'd forget all about that because you'd be looking at your account balance going up and saying, I'm afraid to lose that money. So a lot of it has to do with you maturing as a trader. That's the real hard part of all this. Now, here's another example. This is one. This is from a word trade. So you're looking at your news trader document that you get from me every Sunday or Saturday, and I say it's bullish if the vote count for printing money is at least 360. Now you're gonna have to, you have to do a little work. Yeah, you have to know what 360 means. So you're gonna have to actually make a little effort to understand a little bit about what you're doing. When you think about how ludicrous it is for somebody to tell you, you don't have to know anything, you don't have to do anything, you can become the richest man in the world in 2 years, or person in the world in 2 years. It becomes more and more clear how ridiculous that is as we go along here. So when I tell you, yeah, at some point it wouldn't be a big deal for you to be able to understand this. It's not. It's a very simple concept, but it takes a little time. You can't learn everything today. Just like you can't go to the gym for one day and get in Herculean shape. You can't, you can't become totally healthy in one day by going to the gym for one day. You can't take vitamins for one day and get healthy. It doesn't work that way. When you have some kind of a sickness and you go to the doctor, you don't walk out of the doctor's office cured and feeling perfect. My buddy right now, my gym partner, has got a problem with his back. He went to the chiropractor 4 days ago. Well, he didn't walk out of the chiropractor's office the first day feeling all better. Today, 4 days later, he's starting to get some relief, and by sometime next week, he should be back to normal. So when we say that it takes a while to get good at this particular type of trading, well, it's supposed to. It's not supposed to be you're able to learn it all on the spot. Unfortunately, too many people out there are claiming otherwise. But it makes my job a lot more difficult because people come to expect it. All right, so on this particular event, we expect it to go up at least 50. It actually did go up 50 as of right here. So once it goes up 50, we can put on that 1-minute 60 SMA, and when it goes back through it, we can sell it and put a stop above the high. But the idea is you don't sell it just because the 60 SMA is telling you to sell it. You sell it because you think it's going to go down. And the reason you would think it was going to go down is, God forbid, you're going to have a view on whether you think this currency pair is going to go up or down or not. And that view would be related to before this announcement how you felt about the pound and how you felt about the dollar, how the pound in general was doing, how the pound and the dollar in general was doing, how this news, did it change your view on where the pound is generally. All of this is part of the game. You can't skip all these steps and just say, I'm just going to do the 1 minute 60 SMA. It don't work that way. You have to have, it's a lot more to it. And it's totally worth doing the work if you could put on a trade where you could make a month's pay in 5 minutes or in an hour. That makes it totally worth doing the work to come to the right conclusion. You know, if you're taking a flyer on 1 pound and you're going to make or lose, you know, train fare, it's not worth it. So you have to get to the point where you're making a significant bet to make all this worth it. So this is one we actually did live. Actually, we were trading live this day, and it gave the signal. There was the stop, and we were saying we probably could try to make more based upon technicals, 4-to-1 risk reward, based upon our retracement, and that's because we had another news event occurring here, and we were thinking that with that news event on the horizon the same day, it's unlikely that this was going to be able to maintain all those gains, which it wasn't doing. We got lucky because the first news event you can see here was a negative one. The first part of it, it was another word type of a news event. And then they started saying positive stuff from a really good technical base. So you can kind of see how technicals and fundamentals can be put together. That's what I try to teach. Is that when the technicals and the fundamentals are telling you the same thing. So yeah, you had good news, so it should go up. Now, in fact, it came almost all the way back down to where it started. When you got more good news, it was starting from a very good launch pad, hence very possible to do this. If it had already done this and it already covered much more than it would on a normal day, the chances of it going another big leg up, then we could look at our high-low charts and say, what are the chances of that happening? Well, that happened once in the last 8 years. Do we think it's going to happen today? Well, it happens once out of every 8 years. Do we think it's going to happen today? Well, the answer should be no. And it could happen today. But do you want to be betting on things that happen once every 8 years? Or do you want to be betting on things that appear to have a very good chance of occurring? Which one do you think is going to make you successful? Betting on things that happen once every 8 years, or betting on things that have a very good chance of happening? And the answer is betting on things that have a very good chance of happening. Now, in order to know it has a very good chance of happening, you need to understand and have some kind of statistics to back it up. Hence, that's why we have news trading documents. That's why we have high-low charts. So we have documentation on the technicals, documentation on the fundamentals, and we're hoping to put them together. None of this is going to be helpful if the market ain't moving. Like the month of August has been one of those kind of months where nothing's moving, at least I would say the second half of the month. But that's just the way it is. Now, I do have this News Trader publication. I used to publish a Word document. I stopped doing that because I can't get the information I need because nobody writes about it anymore because it's become so weird, if you will, that nobody even writes about it where I could get opinions and be able to draw the conclusions I need until the day before the news is actually coming out. So what I do now is put out the weekly News Trader Excel document, and then in the Trade Finder I update it and I tell you exactly the day before exactly what the deal is and how I think you should trade it based upon everything that's happened right up until the night before the news. So that's a much more practical way of doing it, so that's what I've been doing. And let's take a look at the Trade Finder. What is it? It's a tool. It's going to help us. It's going to show us numbers and statistics of how to go about trading these things. For people who have a lot of time on their hands, they could actually open up the Trade Finder and go back and see this information all the way back to 2004. I warn you, that's a huge mistake. Trying to say what's happened in 2004 is relevant to what's going on in 2013, 9 years later. In most cases, you'd be wrong to do that. It wouldn't be that helpful because what the market considered important in 2004 is not the same kind of things that they consider important in 2013. Uh, there's a couple of things that are the same: employment reports, retail sales reports, GDP. Those three have always been important. They probably always will be, but many of the other so-called economic indicators are not. So let's take a look at the News Trader publication. That's where I want to finish up today. So I'm going to close that one down and discard all that. Close that one down. Don't want to save any changes in that. And put the News Trader up. And this is a really valuable thing. You know, most people, I understand, don't want to bother with it. And I understand that. I totally understand it. But it is an important part of the game that you're leaving out. So we got 4 things here. We got this week, archive, track record, actual numbers summary. So let's start with the easiest one, actual numbers summary. So you could look at last year by just opening this up. This is what I mean by opening it up. You highlight from A to N, and then you right-click the mouse and you say unhide, and it'll give you all of last year. But I don't want to look at last year because it's too much information. I want to look at this year. What's going on this year? Okay, so the UK interest rate has stayed exactly the same the whole year so far. The printing money for the UK has stayed exactly the same for the whole year. The inflation rate in the UK, it dipped a little bit to 2.4, and now it's holding at 2.8. So it's pretty much the same the whole year. It was a little higher, a little lower, slightly higher, but pretty much the same. The number of people claiming unemployment has been going down pretty much every month, with the most being the latest month. So that's a positive. You know, if I was looking at the pound, I would say that's, if I was going to fill it in, blue being positive, red being negative, I'd give that a blue as a positive. The retail sales the last 3 months, you can see, have been very good. The last couple of months, unemployment's gone down quite a bit. Their service businesses, the number itself has gone from 48 to 51 to 52 to 54 to 56 to 60. This has gone up the whole year, straight up. The GDP went from minus to plus 0.3 to plus 0.6. So this has done very, very well as well. And the way the UK government is talking about printing money or not printing money, interest rates in general, hawkish, the word hawkish means bullish. The word dovish would be bearish. So you can see that over at the beginning of the year, things were pretty bad for the pound for at least the first couple of months. And then things started to change. And so it went from negative in the first couple of months, with the exception being actually this number here, we don't know. I think that was an all-time low. So it didn't really start to improve right away. So for the most part, the pound was doing really shitty at the beginning of the year, but starting in March, the government started saying good things, and the numbers started saying really good things. And if you look at the performance of the pound, so if you look at your high-low charts, let's take a look how the year went for the pound. So if you look at it from January until March, the pound did really lousy. Starting at the beginning of March, the pound has been doing a little better. And if you look at, so the big drop occurred here, and that's when very dovish, okay? meaning very negative. That's what the government was talking, very negative, you say, and that's the market was thinking very negative, and the numbers with the retail sales were getting really worse. The unemployment was going way up, and now that was in February, and by March, things started to improve, with the government being the first one that started to show improvement, and then the numbers, retail sales unexpectedly much better than expected, uh, service better. So you can see that the story here is very similar and probably easier to see than the story here, you know. And, as a technician, the people who just look at charts, you know, if you didn't look at if you didn't consider the economy at all, well, then it would be really a stretch to say you would have caught this move, because you would have thought that this was just a temporary thing on this move. So without considering the fundamentals, it's very easy to look at this and say you would have done fine. But I think you know better if you've actually been trading of how difficult it can be. But this area here was very simple. In fact, in these 2 months, the only trade we did these entire 2 months was to trade the pound against the yen, because the pound was losing value really fast, and so was the yen. So that particular currency pair, the pound against the yen, in the same day was going way up and way down, but it really wasn't going anywhere in particular. So you had a good opportunity. If you look at if we have it right here. So you can see the pound yen wasn't really going anywhere, but it was making big ranges up and down every day. So trading the Jimmy's bands with pound yen worked out great. During that period, it was something we did every day. It worked good for us, but we were able to figure this out because we understood that both the yen and the pound were strongly going down. Another way to trade it would have been easier for some people, would be just have sold the pound or just have sold the Japanese yen. But in doing that, you'd have to deal, you still have to be able to withstand. If you sold the pound and that day it went up 100 points, the question is, realistically, would you still be in your trade or not? And only you know the answer to that. And it's very easy to say, with the benefit of hindsight, oh yeah, Jim, I would have definitely, when it went up like 200 points to stay, 300 points, I would have still been in it. Or here, where it rallied 3 days in a row by 200 points, oh yeah, I would have been selling more, All along the road here, you can see this day went down but came all the way back up. It's very easy with the benefit of looking at it to say I would have just stayed in it. But, all along the road, you finally, because it happens to us sometimes, it happens to me a lot of times, is okay, I see it going down, it's looking really bearish, so I jump in. And that day it goes up. And it starts to go down, so I jump in again. And that day it has a big move up, and then it somehow gets away. So I find it a lot easier for me personally, rather than try and catch these bigger ones, because I don't like to put in 300-point stops on my trades. It's not something I could do for a decent amount on a trade, decent sized trade. I'd rather just trade it one day at a time and take it as it comes, but be aware that the bigger trend is down. To be aware, as this is coming down and starting to make new lows, that I should be trying to sell on that day, and I'm going to try and be selling, but not from the point of view that if it has a 200-point up day, I'm just going to stay with it and let it go 200 points against me. If it's going down that day and has a clear trend of going down, well, that's what I'm going to be doing. So when I see it look like it's making new lows, my strategy is going to be, okay, today I'm just going to try to sell pound dollar. That's it. And that's how I'd look at it. And the fact that I'm aware of why it's going down, that there's a lot of, not only is there negative news coming out from an economy point of view, but also the market is talking negatively about it, and they have their reasons. Now, if you don't know that the market's doing that, well then, if you leave all of that out, again, it becomes a lot more difficult. So the idea for me of trading the news is just to be able to get a feel for that. All right, that's one part of it. Let's get out of there. Now, another part of it is the track records. Now, I'm just looking at 2013. Why am I doing that? Am I trying to impress you that these things all make the moves they're supposed to move? No, that's not the idea. The idea is this year, currently, they're doing what they're supposed to be doing based upon the parameters we set up for them. And that's important. By adding in last year, 5 years ago, all you're doing is you're getting away from the reality of what's going on now, and you're trying to average in what it's been doing over a long period of time, and your conclusions you draw become worse. By staying with just the most current, your conclusions are better because you're basing it on what's going on now. That's the idea of why the track record is just for this year. And the actual archive, like I said, you can open it up if you wanted to and go back 10 years. If you feel like doing that, go ahead. Please don't email me and tell me your theory based upon 10 years ago. I just don't care because I don't think it's relevant. That's my own opinion. But if you think it's relevant, by all means, you should trade it. I look at 1 year at a time. I'm looking at this year, and I got enough information here to get a feel for things. And this is what it looks like, and the statistics are very clear. Everything's here for you. These are the parameters. If it's different by 15, it should move 50 before it moves 20 in the other direction. They're all exactly the same, and it's there for every news release. So next week we have a quiet week for news. We really don't have much of anything. But then the following week after that, we have most of the news comes out the first week of the month. So the following week, we got all this news. Coincidentally, I'll happen to be in London next week, and there's no news. And as soon as I get home, we got all this news. We're going to be trading live the non-farm payroll. So we're going to be trading this one. I believe we're going to be trading that live. Let me take a look. Yep, pick that one for a live event because that's when something important is going to be going on. And all of these things are important, and they're all going to be factors. Everyone's concerned about, we got the U.S. FOMC meeting in here somewhere. Where the heck is that's coming up? Where the U.S. is going to decide whether or not they're going to over here. So on the 18th of September, that's going to be the next time the U.S. decides whether or not they're going to start to stop printing money or not. That has a direct impact on the dollar, and a big part of that decision is going to be based on, well, how's the employment numbers look? That's going to be a big factor in it. How's the U.S. retail sales look? These things are all related. But again, like going to the gym, you can't go to the gym for one day and get in shape. You can't become a news trader by coming to one 75-minute webinar. Speaking of which, we're a little over time here, so I don't, on Saturday, I like to go much overtime. So I'm going to cut it here and leave it here. There were a couple of really good examples of the 1-minute 60 SMA trade. I think I'll show you them before we go. It'll only take a minute, and then we'll call it a ball game. Then I'll do the usual, take some questions. Okay, so here's one. There was a couple that didn't work out, but these couple did work out, just to teach you. Let's see. All right, so here's one. So you had the pound went down quite a bit, 60 points. You put your 1-minute 60 SMA up, picked it up here, and from there the pound went up 200 points in the rest of the day. 1-to-1 risk reward would have been decent, but there was a lot more in it. Again, that comes with practice and having a view that you think it could go up more, but that's not a bad trade either. Pick up 80 points on that ain't bad either. That's one, and I got another one here. I just jotted down a couple. Here's one from Canada, and that's that took place here. So that doesn't quite look right. No, that would be, yeah, Monday, review of Friday. Yeah, it should be here. No, not there. Let me try one more. Maybe, it was Friday, so it would be Monday. Okay, here's a Canada news. So you got they expected to gain 6,000 jobs. They actually lost 40,000 jobs. So that's really negative. So dollar Canada will go lower, the Canadian currency will go up. Dollar Canada will go higher, the Canadian currency will go down because the news was really bad. And once it went up 50 points in the first minute. So once it does that, you put up this 1 minute 60 SMA. So when the price is up here, you're putting that line down here. So you can kind of see how it takes it took an hour, pretty much exactly an hour before you actually got the signal. So therefore, you had plenty of time to put, and by now the spreads are back to normal. The brokers are making normal prices. The market's hardly moving. These 1 minute increments, you can see the market's hardly moving. So in 1 minute, the whole impact of that news was eaten up, and this had good, nice big move back down. This is a smaller, shorter term trade, quick 20 points, but there was significantly more in it. So there you go. Another example of it. All right, I'm way over time. I apologize for that. We're already 15 minutes over, so I'm going to call it a day on that. But I'm going to give you a chance. If you have any questions, I'm happy to take them. So I'm going to stop talking, take a little rest for just a couple of minutes, 3 minutes. Give you 3 minutes if you have a question to type it in. So go ahead, type in your questions. I'll see you in 3 minutes. Okay, I got one question here. Let me jump on this one here. How would you have traded last FOMC news when market is down and up? How would you have traded the last FOMC news? Let's take a look. I don't remember. Let's see. Let's see. This week. Now, when you say the last FOMC news, do you mean the minutes of the news? Do you mean the minutes or the actual Annie, you have to be a little more specific here. The last FOMC news, do you mean the minutes or do you mean the one before that, the actual meeting? The minutes. Okay, the minutes of the meeting. All right, this is not something we normally would trade, but it appeared for this one that the market, well, I could tell you, we decided to leave it alone totally, I think. Let me, the answer to that would be in trade, would be in the PowerPoint, right? So let me put it back up here. You're kind of telling me you're not listening to your trade finder, but that's okay. 821, that means 822's trade finder for a review. Or 821, we can look at 821's trade finder, and that would tell us in the preview what we expected. And okay, so what we said is what I told you is I have no clue what they're going to do. Taper would be stocks down. Now, okay, what I was thinking on this one was, if I remember correctly, I was thinking the dollar yen had a better chance of going down than up. I was trying to rationalize how this would be played, but for the most part, there was nothing clear to do because nobody really understood what's going to happen. Basically, at the meeting, you have half the guys who think they should taper and half that think they shouldn't. So there was no way of knowing what to do with this. I think what I said was, if I remember correctly, I think I said I think the dollar yen has a better chance to go down than up on this. And I was thinking that if they taper, if they talk about tapering, then stocks would probably go down, and the dollar yen pair had been following stocks. So I thought that the dollar yen pair would go down if they did to talk more about tapering than not tapering. And then if they said that they're not going to taper, then that would be good for stocks and that the dollar yen pair should go up. But I was thinking that maybe it wouldn't, or it would try to go up and it would go back down, because I think the market is I think that the idea that stocks should go up if the government continues to print the hell out of the money, that should be good for the dollar. I mean, that idea seems wrong. It seems to be good for stocks, that stocks keep going up when the government says they're going to keep printing money. But I think everybody who has any kind of rational brain would realize that, that just don't make any sense. That's like saying that, you're in credit card debt up to your eyeballs. So the fact that more credit cards are willing to give you credit, you'll keep spending money, and that's a good thing. See, that can't possibly be a good thing. So I was thinking that the market, either way, I would expect dollar yen to go down. And if it did go up, I'd expect it to go back down. If you go and listen to the recording from the 21st, I'm pretty sure that's what I said. I'm about 99% sure. So on the 22nd, let's just see how it worked out. Okay, so here it was, and here's the dollar yen pair. So, okay, so it shot up and it came back down. Not quite to where it started, but it kind of peaked out after a few minutes. But it wasn't even very clear, and it wasn't that huge of a move from 55 to 95. So it only went 40, didn't go at least 50, so we wouldn't get a 1 minute 60 SMA going based upon the rules. And it also wasn't clear. It wasn't like they said, okay, we're not going to taper. They didn't quite say that. They really didn't say anything. If you read what the analysts said about it, they said that they have no clue what the Fed's talking about, which is kind of scary. Okay, that's the best I can give you. You're welcome. Would you consider trading something that isn't considered in News Trader? U.S. new home sales 3 p.m. was worse for 6 months, and Eurodollar went up about 60 points. Yeah, I mean, you certainly could. Any news event where you get a number that appears to be way off the mark, it could be traded. Sure, nothing wrong with that. New home sales, it used to be a tradable number way back when, but it stopped being tradable because it became a non-issue. Let's see. It's in your archive. You just have to look for it. So if you go to U.S. and if you open all the U.S. by going like that, and you say unhide everything, you can find the U.S. I think I stopped in 2008 because it was no longer tradable. Consumer confidence, all these, let's see, durable goods. See, these are all ones that we used to trade at Chicago. They all died out. They're all here. We used to trade them all, but they all, over time, lost their significance, so we stopped trading them. But the answer is certainly yes. Here's new home sales. So it used to be tradable, and it used to have a decent track record. But over time, the market, it became such a broken record that the numbers just kept going down. Actually, I discontinued it in March of 2011. New home sales, and that's because you were getting a lot more no's than yeses. In other words, it wasn't moving in a predictable way, so we dumped it. Now, all of a sudden, the housing numbers are starting to make somewhat of a comeback, so they're becoming more important. So if you see a number that's much different, if you wanted to, you could track it again if it's something you wanted to do. You'd probably figure out something to do with it. But yeah, you could. But you got to be careful because sometimes it'll work, sometimes it won't, and that's true of any news event. But when it's very different, I think Friday's number was significantly different. But keep in mind, Colin, that another time, it's very possible that you could get a much different number for a housing number, and it won't move at all, So you got to be careful. You got to be careful with them. Right now, the market seems very jittery, and try not to base anything on one number, one time. If you see a pattern, if you were really interested, you would go back since the beginning of the year and look at those new home sales numbers, what they expected, what they actually got, and look what they actually moved like in the euro-dollar pair every month this year, and then look at the size of those differences and see whether it makes sense. So the answer is yes. You can always pick one number, out of the hat, and it may cause a move on that day, but you got to be very careful with doing that. So news trader, when it's not considered a news trader, it was from 2004 to 2011, but sometime in 2011 we decided to stop following it. So it's not like we never followed it. It's just that it became such a non-event. And I think a lot of the news numbers even now are still non-events. Okay? Cheers. All right, that's about it, guys. We're way over time here, so I hope you enjoyed today's session. We'll pick it up from here next time. So, all right, guys, take care. Jimmy Young signing off. Bye-bye.